Hey, what's going on, traders? Welcome to the video. This is Chris from Varillo Trading. I welcome you here today. We're going to talk about a few things that I think are relevant to trading, whether you do day trading or swing trading, but more into the realm of day trading here because we're going to talk about things like trading lifestyle. We're going to cover recency bias, and I'm also going to mention cognitive dissonance in this video today, guys. So if you enjoyed this type of content, please remember to smash the like button and subscribe to the YouTube channel because that helps the YouTube algorithm, and that's what I need for this channel to keep working. So let's go. All right, guys, so we'll just look at a recording of the markets from this morning here, and maybe I'll put the bonds on so that way it's a more relaxing sort of view here. Now, this is basically what I wanted to talk about, and it's basically relating to trading lifestyle. And this is a great topic. I love talking about day trading lifestyle because, believe it or not, this might be the one thing that's holding you back from actually being profitable in the marketplace. I know it's something that's holding me back. What I'm trying to get across here is that you could have all of the tools and all of the knowledge and all of the know-how when it comes to your analysis, when it comes to your execution, when it comes to the tools you use to trade and how you interpret them. You could be a total wizard. However, if you are not in shape on a daily basis, if you're not carrying that discipline to show up to the market every day, do the work and preparation required before and after each session, then you're at a big disadvantage in this game. And this might be the one thing that's holding you back from actually making consistent profit. I'm going to give you my own perspective on this. And as the video progresses, we're also going to cover a few other topics that I think have to do with why traders have a lot of trouble in the marketplace and why they can cause themselves a great deal of pain. So I want to kind of debunk this stuff. By no means am I an expert, master, guru. All I'm doing is sharing with you guys some of my experiences, some of my thoughts in regards to trading, in regards to the marketplace. So this is what has been on my mind since last week. So in regards to the lifestyle aspect, I believe that in order to truly prepare and trade the US morning session, whether you trade the bonds or equities, I believe that the trader needs to have some sort of morning preparation before they begin to trade, which means that you have to get up early on a consistent basis. I'm only saying this because I have tried to do the rockstar trader lifestyle thing where I'll get up, 30 minutes before the market and just kind of look where we're at, watch the first 15 minutes and then just kind of wing it. I've done that. And I would say that on average, a trader who is more prepared, meaning a trader who has done their analysis, who knows their contextual zones to be watching on the session, will be more prepared than the trader who has not done that same work. And all I'm saying here is that the trader who gets up consistently an hour and a half to 2 hours before the market opens and does their work and potentially meditation, has a nice breakfast, and by the time the market opens is well relaxed, this trader is at an advantage compared to the trader who gets up 30 minutes before the market opens and just wings it and does a rock star type of trader lifestyle where they show up, they start scalping it and whatever. I'm not saying that's impossible. I'm sure there's some traders out there who do that, guys that are really experienced, who know exactly what they're looking for and whatnot. I would say I can't do that. I like to be relaxed when it comes time to trade the markets. Okay, so this is where I'm coming from. Now I'm going to go into some personal aspects of my lifestyle and how certain things in my life I noticed were slightly interfering with my trading routine. And what this is I'm a musician and I have some weekly gigs. I'm really grateful that I've been able to play consistently pretty recently here with my group, and we host these jam sessions on a weekly basis and a lot of people come and it's really fun. However, the problem with these jam sessions is that I often get home at midnight, 1 in the morning, and by the time I hit my bed, it's after 1 in the morning. How the hell am I going to get up at 7 o'clock to trade the bonds and the stock market? Forget it. It's not going to happen. That's what I'm talking about. So doing these gigs, unfortunately, does negatively impact my trading business and my trading routine. And this is something that I have had to come to terms with. And actually, in the past, I've had similar experiences where I get home from gigs and the next morning I'll still trade anyways, and I would just be trading while not 100% focused. And then obviously I realized later that I wasn't totally focused, and I attributed my loss of money or break-even trading to the fact that I was trading while not totally focused. However, I repeated this pattern many times for probably over a year. Until recently, where I finally made the realization that in trading, it doesn't matter how much knowledge you have and the tools and the methods you use. If you're not in shape as a trader to manually execute these things, you are going to suffer greatly from things like recency bias and potentially lack of confidence when it comes to executing your trades on a consistent basis. So basically what I'm trying to say is that these late night gigs do not help my trading routine, and I'm trying to currently find a way to balance this in my routine so that I can have the focus necessary to do my trading in the morning. This really goes in now to the number one word here, which I'm going to say, which is the word discipline. Now, a lot of traders will throw around this word as if it's candy. Discipline, mindset. But do you really know what discipline is? I will try to explain to you what I think discipline is. So discipline is something that is commonly understood among people who are self-employed. I've been self-employed for I think over 6-7 years at this point. I know what it is to have discipline. I also know what it is to lack discipline. The bottom line here is that when you're a self-directed trader, when you trade for yourself with your own money, the discipline factor of getting up every day, doing your preparations, knowing exactly which setups you're trading and trading them as if you were a machine set to execute them, that's where the discipline comes in. It's really about getting up every day at the same time, doing what you have to do on a daily basis, planning your stuff out, executing the trades as they come through. As well as when the trades are over, make sure to write them down, hashtag them, and journal them in whichever way you do, and then review exactly what happened and things that you could have potentially improved on, potentially something you were not seeing in the moment if it was a bad trade. And if it was something you weren't seeing, then you need to be able to understand what could have been attributing to your potential lack of focus or potentially cognitive dissonance or recency bias, which are two things that I want to talk about now in this video. So let's talk about recency bias, because I think this is a really big one. What recency bias is it's actually human nature. It's actually something that is totally normal for a human to do. And I'll read you my own sort of definition of it. Recency bias: inconsistent trade management from trade to trade due to winning, losing, or choppy streaks. The trader is more risk averse after losses, and the trader is more risk taking after winners. This inconsistency in trade management seems to be where machines have an edge over human execution. An example now: cutting winners short because you panicked, because you got spooked, and your last two trades were break-evens or losses, and you didn't want this next one to be another loss. Another one is not scratching a loser fast enough since you're up on the day, giving the benefit of the doubt to the market when you're up on the day, basically becoming complacent and overconfident. These are things that happen to humans. Actually, it's totally a human thing that when you win, to become excited about winning, and you tend to become more confident, because it is actually known that when people win, it actually increases their testosterone levels, and testosterone is known to increase confidence. So it makes absolute sense that traders who make a profit on a trade or two or three in a row, on the fourth trade might be more risk taking than they should be. And this is really important stuff, I think, for scalpers to be aware of. And it's really about treating every trade the same way. And I do believe that this is why a lot of the big institutions are known for using machines to execute their trade ideas, simply because it takes away the human aspect out of the trade management. Not to say the human is totally incapable of managing these trades, but I am saying that humans are more susceptible to things like recency bias. All right, let me know if you guys have suffered from recency bias before. I certainly have. Let me know in the comments below. The next thing here, we're going to talk about cognitive dissonance. At least this is what it's labeled as. It's really something that a lot of us traders can relate to. All of you have experienced some form of cognitive dissonance in your trading before. There's a pretty complex definition out there online. I'm going to explain cognitive dissonance in my own words in a way that I think relates to my own trading. And it's like this: knowing or acknowledging one thing as being a fact based on an objective analysis, and for whatever reason, taking a trade that goes directly against that fact that you acknowledged. An example: I know the market is favoring the bears on the 15-minute time frame or other market context, so it makes sense to generally avoid the long side since the probabilities are favoring the bears. The trader takes the long trade anyways, and they get annoyed when they lose. Well, that's a perfect example of cognitive dissonance. Sometimes traders can experience what is not really purely cognitive dissonance, which simply is just ignoring things in front of them sometimes. And sometimes it could be due to a self-destructive nature or a thought that they have, that they potentially think that they're not good enough or they don't deserve it. And a lot of times these types of thoughts and ideas could actually be deeply rooted, and they could be rooted in things from childhood trauma or issues you're having with parents or friends, because the market has a way of telling you the truth. That's why trading is considered a form of personal development, because it forces traders to dig deeper sometimes and really think about what drove them to make certain decisions. And a lot of times it can be very tricky to identify why exactly you made decisions. That's why a lot of times it's about those little puzzle pieces, things like the lifestyle, things like understanding recency bias and human tendencies. All these little puzzle pieces make a difference when it comes to your decision-making process. I might be blabbing on, but if someone out there relates to this, please don't forget to smash the like button. It really helps out. Thanks, guys. So again, the example of cognitive dissonance, you're looking at the market, 15-minute chart, it's going straight down, yet you're looking for a long trade. Now, in simple terms, there's nothing wrong with looking for the long trade as long as there is something to support it. However, if you're just looking for a long trade because you see a breakout and you want to trade it, that is an easy way to lose money, especially if there is other market context indicating that the probabilities are favoring the bears on the 15-minute chart. I do believe that for whatever trade idea you have, there's always going to be multiple factors that sometimes can be disagreeing with other factors that you use to make your decisions in trading. And whenever this happens, it's very important to see it and acknowledge the fact that there is something conflicting with your trading idea, potentially on a slightly larger time frame. Some traders like to call that multiple factors of confluence. It's quite an important thing, because you can have a great trade idea, you can have a great trade location on one time frame, but if you zoom out a bit onto a 15 or a 30-minute chart, you'll see that based on the current market context and what has just happened, this location is actually a bad trade location, and you should not look to trade here because there's something conflicting there on a larger time frame. You guys know what I mean? So I guess cognitive dissonance is basically knowing something about the market and just ignoring it and doing the opposite. That's a simple definition of cognitive dissonance. But also, I would say cognitive dissonance can also extend into the realm of taking trades even when you know there is something conflicting with your trade decision, location, or the decision for the trade altogether. Dissonance, or things that are interfering with the trade idea. Often I've noticed that when there are trades that seem to be lining up potentially on multiple time frames at once, often those trades tend to be the hardest to get filled on, because many traders also see this and they're wanting this trade as well. And that's why it's often said that the best trades in the market are often the hardest to get filled on an order on. Alright guys, so that's pretty much what I wanted to cover in this video. Now let's see if there's anything on the internet that I can find. The failure to resolve cognitive dissonances can lead to irrational decision making as a person contradicts their own self-belief. What I can get from this is our trader receives a signal from the market, an objective piece of information. The market is doing this right now. And for whatever reason, when it comes time to actually trade, it seems that the trader is ignoring this information that is clear in front of their face and that they've already acknowledged, almost as if they're trying to prove themselves wrong in that moment. So I know this is the truth, but I'm gonna do the opposite because I wanna try and be right. So I don't know if that's a good way of explaining it. Let me know your experiences with cognitive dissonance down below, guys. I'm happy to chat with you guys in the comments. And I'll catch you guys soon. Hope you enjoyed it. Take care. Bye.